Hello and welcome to your own channel. Let's talk business once again. I'm Ravi and today we are talking about the Lloyd's realistic disaster scenario or RDS, a key part of how Lloyd's insurance market prepare for the major disaster. So let's start talking business. So before getting into the deeper aspect of RDS, let's see what is RDS and why does it really matter. So Lloyd's RDS is basically a set of what if disaster scenario that insurance company uses to test how ready they are for major events like hurricanes, earthquake, flood, cyber risk, or even terrorism. The idea is to make sure that these companies can handle the worst case scenario and still have money to pay out the claim when disaster strikes. Every year, Lloyd's asks insurance companies to take part in these what if tests, imagining how much they will lose if the major disaster hit, like huge storms, earthquake, cyber attack, etc. These aren't prediction, but rather a smart practice run that help to keep the entire insurance market strong, stable, and ready to face whatever comes next. There are three types of RDS: compulsory scenarios, de-minimize, and alternative scenarios. Let's talk about all of these scenarios one by one. Let's start with the compulsory scenarios. Every syndicate has to model and report on 20 big disaster events. Think like hurricanes, earthquakes, cyber attack, terrorism, and these are mandatory scenarios. So you can pause the video and you can have a look on all these scenarios which is mentioned here. I picked up these scenarios from Lloyd's website. Then there are de-minimize scenarios, which are a bit different. These covers events aren't expected to create a huge losses but still matter for the risk check point of view. The company only report on these losses if the losses get above certain threshold. Example include a major marine instance, aviation crash, satellite risk, liability issues, or maybe a political risk. And finally, the alternative scenario, which is very specific to the syndicate. So syndicate has to pick their own extra 2 disaster scenarios to model, and they have to model the entire disaster based on their individual risk portfolio. So these are the very specific to the syndicate risk profile. So these 3 scenarios help Lloyd's and the market to understand and prepare for the wide range of potential losses, ensuring the robust risk management and capital planning. Lloyd's update and publishes this scenario every year so that the market stay prepared for wide range of possible disasters. In short, these scenarios is like a reality check for insurance company. It helps to make sure that they are ready for anything unexpected, can cover claim even after 2 huge disaster, and really cover all the risk they are dealing with. It's all about protecting customer, keeping insurance market solid, and making sure the company aren't caught off guard. Though we are continuously talking about the importance of RDS, but I think we should evaluate all those importance across these 6 important points. So from the realistic preparation point of view, this kind of a scenario help insurance companies and risk manager get ready for something that actually possible, like having 2 major hurricanes back to back in the same season, which does happen. It also about the money side. Estimating the losses from 2 big disasters in a row shows if the insurer have enough money to pay claim or deal with all the possible scenarios, even if the things get extreme. Another key point is reinsurance. The scenario imagines that there is no time to buy extra coverages between the storm. So the company really have to plan ahead to protect themselves from the double trouble. Regulators and the Lloyd's uses this scenario to seriously stress test the insurers, making sure that they are actually surviving if things get really bad in the single year. It's not only about test, it's about understanding the entire exposure and the impact of this disaster on the entire exposure. And finally, by thinking all this through ahead of time, insurers can get actually better at the claim handling, helping customer and bouncing back after the disaster struck. So Lloyd release the disaster scenarios and instruction early in the year. Then they usually set a deadline for submission, which is somewhere May, June, although it can change. Managing agent have to get their completed report by whatever the date Lloyd's set in their official guideline. If they don't submit the RDS report to Lloyd's on time, it is basically breaking their rule. Lloyd's will probably reach out to chase the missing report. If they keep missing the deadline, there could be a serious consequences like more regulatory scrutiny, official warnings, or other compliance issue. If it happens a lot, it might even hurt the syndicate's reputation with Lloyd's and make it harder to do business within the Lloyd's in future. So the bottom line is, submitting this report on time is must to avoid trouble and protect your standing or syndicate standing. RDS document doesn't specifically mention about the FCA or PRA involvement in the RDS submission process. It mainly focuses on Lloyd's expectation from the managing agent and syndicate. But in reality, Lloyd's is regulated by FCA and PRA. These regulators set important standards for managing risk and capital. The RDS process is designed to fit those regulatory expectations. So it's kind of a way for Lloyd to show that they are on top of the stress testing and risk management. The FCA and PRA might review or audit these processes and could ask for the proof from Lloyd that everyone is following the best practice or not. So even though the RDS document published by Lloyd doesn't say about the involvement of FCA and PRA, but the RDS process is a part of the bigger regulatory framework picture. These disaster scenarios aren't meant to be run for the individual risk or individual policy. Instead, they are designed to look for the bigger picture, how the whole syndicate of the portfolio might be affected by the bigger disaster. That's because the scenario includes things like widespread damage, spike in demand, the impact on infrastructure, which just don't apply on the single risk. Managing agents are asked to estimate the total loss across the industry and their syndicate overall exposure. So if you want to assess the risk for the single asset or a policy, you use a different model, not the RDS. So in short, the RDS is built for the bigger picture, not for the smaller details. But that doesn't mean that you cannot use RDS for the individual risk. Underwriters do have a possibility to use RDS for even evaluating the single risk. How? The RDS scenario shows which region, asset type or industries are most vulnerable to the bigger disasters. And underwriter can use this to spot if the individual property business or vessels they are about to insure is falling under the high risk area or not. If the RDS shows the certain area or asset caught a big loss overall, the underwriter might charge a higher premium, add stricter terms, or raise the deductible on those individual risks. RDS help insurers to keep eye on how much risk they have in their portfolio. When considering a new risk, underwriter check if it would push their exposure too high for a certain scenarios and decide whether to accept or change the terms for that particular diesel risk. The RDS result is also can influence your decision to buy the reinsurance. If the new risk would increase the exposure too much, the underwriter might demand extra reinsurance coverage. And finally, the RDS result reveal if the portfolio is very heavy and concentrated, so the underwriter might think to diversify the portfolio. So basically, the RDS gives the underwriter a bigger picture to evaluate even a single risk for a better decision making. Well, that's all about today's video presentation. The idea is to give you an introduction about the RDS, but as I said earlier, this video presentation is a part of the series. In next video presentation, we will talk about the individual scenario in a greater detail. Till then, take good care of yourself and see you soon. Bye-bye.